Good morning, everyone. Thank you for joining us for this month's edition of Coffee Talk. My name is Sean O'Brien. Whoops, make sure my screen will move. There we go. My name is Sean O'Brien, and as always, pleased to be joined by Steve Huntington. Steve, if you want to introduce yourself.
Yeah, thanks for joining us again, everyone, this morning. My name is Steve Huntington. I'm the Director of Analytics here at QwickAnalytics. Been working with community banks for my entire career, for everything from strategic planning, capital planning, valuation, M&A advisory, and model design. And I've been working with Sean here at QuickRate for a little over a decade.
Great. Thanks, Steve. I suspect we have a pretty large crowd today. Use the Q&A box and the chat feature are our most effective ways to get questions into us. I think today what our expectation is we're going to do a few poll questions. We'll take your questions, much like last month where we anticipate there may be more than we can get answered. Our intention is over the weekend and on Monday to put all of those into a document that we can send out along with a link to today's recording as well as a copy of the slides. So rest assured, if we don't get to your question today, then we will address those early next week and get everything out to everybody. We know that we're kind of down to the wire here in the first quarter, so we want to make sure we can be as helpful as we possibly can. As always, we are continuing to update and try to modify and enhance the tool based on user experience and suggestions and just things that we may have overlooked or undervalued in your eyes. And so again, we continually are making some some improvements. We do have some that Steve's going to talk about this morning that will go into effect hopefully over the weekend. So Steve, I don't know if you want to talk through them first or if you just want to take the screen or how you want to handle it.
Yeah, I'll talk through them for a second and then take the screen. So first off, two things. After we sort of relayed out the tool to more closely follow the accounting entries that we'd all be making now that we're kind of filling out call reports in a CECL world, focusing on the three different reserves that we need in a separate manner, right? The ACL for the loan portfolio, for the securities portfolio, and then separately for the unfunded commitments. We got a lot of user feedback that people were looking for a kind of a basic.
Steve, hey, just 1 second. Some of the participants are having a little bit of difficulty with your volume, so I don't know if you can. It's low, and some people can't hear you.
All right, let me switch to a different microphone. Hold on.
Is that any better?
Much better.
Much better. All right. One of the many different microphones floating around here. We had a lot of users asking us for a kind of a simple, straightforward summary page, which showed some of the most important CECL metrics, and then gave sort of that calculation of overall impact. And so we added a new summary page, which I'll preview for you guys today here. It's something that will be continuing to enhance over time. So if there's things that aren't on it that you'd like to see, we'd love that feedback. Second enhancement is we've always been looking for ways to give some more flexibility and customization where certain users are looking for when it comes to the historical data, the look back periods that we're using to identify what history would show that we need in a reserve from a life of loan CECL sort of standpoint. And so that's sort of where we decided to make an enhancement. I think the best thing to do is probably just to go ahead and share my screen now. So let me do that. Can you see it, John?
Yes, I can.
Excellent. So on my screen here, if we go, you notice there's a new tab that's just called Summary. And what that tab has in it is it shows the output from the tool, right? The calculated ACL and the total current loan balance and showing a ratio. Obviously, this is not accurate yet. This is a new scenario before we plug in all the warms and everything else. So these values are going to look a little bit off for our sample institution, but we give a summary of the loan portfolio ACL, the securities ACL, and then the unfunded commitments ACL and their relative balances. And then we also show that from a last period. So if you want to plug in your values from last month, if you do this on a monthly basis, or last quarter, if you do it on a quarterly basis, just so you can see some basic overall change in reserve values over time, that's what we have for this last period here. It defaults to the second most recent call report period. So if you're doing this as of 12/31, for example, and you have these are sort of the outputs from the tool, the previous quarter's values, so you can kind of compare quarter to quarter. And then down here, a couple summary charts just to help visualize those trends in ACL over time. These are sort of annual values, you know, your bank versus the peer group for ACL trends, and then on a quarterly basis, ACL. And when we say ACL/ALLL, so it's going to flow, right? The previous periods are going to be using your old methodology, and the new periods will be using the new CECL methodology, but it's still the same reserve value, right, over time. And this is the loan loss reserve, so the loan ACL as a percentage of a loan portfolio. That's the update for the summary page, or a new summary tab. But for those of you that really like to dig into the details and look closely at your look back periods, but you'll notice the enhancement on the historical analysis tab. This is where we look at all those details. Again, this is a fresh scenario for our sample institution, so the WARMs haven't been updated with more realistic ones. They're just those default kind of values. But what you see when you scroll down to the bottom, this is the most important part of your historical tab. This is what shows you what your net charge-off ratios have been over time for each of your segments, right? And then we aggregate those loss rates over time to calculate a lifetime, right, multi-year lifetime loss rate. And questions that we've used around, what if we wanted to use a much longer or much shorter look back period than the duration of our portfolio, right? What if we wanted a look back period not to match the WARMs? And so our tool has always been designed for simplicity's sake, for mathematics' sake, and straightforwardness to match up the duration of a look back period. If you have a WARM of 5 years, we want to use a look back period of 5 years, so we don't have to do extra math. That is still the way the tool works by default. But if you have a situation where you want to use, let's say, a 10-year look back period, but you only have a 5-year WARM, or on the other side of the coin, if you have a very short duration portfolio, right, that have, let's say, a 3/4 of a year, 0.75 years WARM, but you want to take into account a much longer historical period in order to calculate your historical lifetime loss rate. We have to add in some additional math, right? If you have a WARM of 2 years, but a look back period of 4 years, you have to take that look back period value and divide it by 2 to get a lifetime value. So let's say for example, we had a 5-year remaining life of our mortgage loans. We type in that, everything, oh, hold on. Might have logged me out.
That's why we're in the development site and still testing.
Yeah, I noticed nobody recognizes that red bar up top. That red bar up top just signifies that this is an internal version of the tool. So let's let this load back up. Again, it loads right back up to this new summary tab. If you don't want to use the new summary tab at this point, you certainly don't have to export it. Again, our exporting allows you to pick and choose exactly what you want to PDF, what you want to turn into Excel for sharing purposes. So if the summary tab is helpful, great. If it's not, you certainly don't have to export it with the rest of the tool. Now, when I go to the historical analysis tab here, if I change a WARM to a longer value, all right. So let's go back, Sean, to the actually, you know what? I can do it in here anyway.
Yeah, so a question just came in. They don't see the new summary tab. It's not out there yet. As Steve said, we're in our development site. So this is something that will be there next week. Hopefully.
And it's something we're, as you can see, actively finishing the development on as we speak. But if you have a 5-year warm and you want to use a 10-year look back period, you can now change the beginning or the end of a look back period independently. So you can choose a longer or a shorter look back period, even if you're not changing your warm. And right now it's not letting me do it. So if you change the look back period to say 10 years, right, but you have a 5-year warm, your multiplier here will be 0.5. So we'll add up aggregate losses over the entire 10-year look back period, but then we'll divide it by 2, right? So that we have a 5-year lifetime loss rate. So the concept of the lifetime loss rate is the same. Everything conceptually is the same. If you don't want to change the duration of a look back period, if you'd like things the way they are, everything will continue functioning as it always has. But if you want some more flexibility to have a longer look back period, let's say, even though you have a shorter warm, to take into account additional historical data and then do some additional math to make sure the lifetime loss rate is accurate, that's what this new functionality is designed to do.
Yeah, if you think about it, right? So for many of you, let's just say your most recent warm was 3, 4, even 5 years. But for many of us, we haven't experienced any net charge-off activity, during that period of time. This allows you the flexibility to kind of pull in a longer window, but like Steve said, still kind of recalibrate it into what your existing warm is. So it just is it's just an additional level of flexibility that we thought would be helpful, to many of you. All right, let me take the screen back, Steve.
Yeah, go ahead.
All right. Okay. Let's see. There we go. So you covered this page again. When we took away the summary page or the summary we had on our initial loan portfolio page, we certainly heard from many of you how much you enjoyed, kind of just a recap. And so, again, we've tried to not only bring it back, but also just provide a little bit more information here as well. Steve, anything you want to add before we move from this slide?
No, that's just a slide of, exactly. We just talked about the new functionality that'll be up next week on the summary tab. I forgot to tell our programmers to stop poking around with the dev site while we were doing the webinar this morning. So that's why there was a little snafu there.
Understood. Okay. All right. Again, Steve kind of touched on this. Anything, you want to add on this still shot before we move on?
Nope. So this is an example of that, a screenshot of that. You can see down at the bottom there. Let's say you have a 6-year warm for your mortgage loans, but you wanted to have a longer look back period. I changed the starting point of a look back period to the fourth quarter of 2014, which is more like, gives us more like 8 years worth of look back, but you only have a 6-year warm, right? So we have to take that 8-year lifetime look back loss rate and multiply it by 0.73 to get a lifetime loss rate. So again, some additional flexibility for look back periods if you're interested. If you like it the way it is, you don't have to mess with this part of it. It'll still continue working as it always has. One also additional thing to note, we've now starting to allow users to overwrite or override that final historical lifetime loss rate value. So on the historical tab, we get users a lot of times where they had some issues with some call reporting in the past, or a historical loss rate that was reclassified at some point, and they'd rather, we've always kind of worked with users to make those adjustments in the Q factor side, as opposed to trying to go in and actually change your factual call report history. However, there are situations where you might want to actually just go in and change it in the history, as opposed to dealing with it via Q factors. So this allows you to kind of take that historical lifetime loss rate and override it to something different if there's something very specific about your situation where your historical is inaccurate due to a reclassification or something else that happened in your data.
Great. So so again, I think the important point here is, obviously, if you're happy the way things are working now, you don't have to worry about any of this. This is, again, just a next level of flexibility to address a lot of the instances or scenarios where, again, we've had users request a little bit more granularity and flexibility than we initially provided. Okay, so Steve here again, kind of just a recap, but anything you want to share on the update here, the layout update?
Yeah, this is something that we covered last month. We sent an email about when we made this update, and then we also talked about it on our. We did a little separate webinar about it.
Yep.
We mentioned in our last coffee talk. But again, this was just the functional structuring of the tool to focus and on the actual call report entries that we're all now having to start to fill out on the 051s or 041s, whichever ones you're filling out. So 3 completely separate and independent reserves, and the tool now reflects those 3 calculations on the balance sheet on the call report. The next couple slides will show you just kind of where those are if you want to just quickly scroll through. This was the older kind of legacy layout where we added up all the different reserves to kind of a total CECL impact value, which was very helpful in kind of preparing for CECL, but not very helpful in filling out the actual call report entries. If you go to the next slide, this is, I believe, yeah, these are where the actual values go on the call report. We have for the securities, for the held to maturity securities, the value there you're filling in is got to be net of the securities ACL. So there's no separate line item right here, at least on the summary on Schedule RC. There's no separate line item to show the reserve for the held to maturity securities. There is a line item on a different supporting schedule that changes in reserve schedule, but not on the call report on the balance sheet. There is, of course, obviously on the balance sheet, the allowance for the ACL for the loan portfolio. That's always been there. The call report code is not changing. It's still Archon 3123 like it always has been, but it'll be under CECL now for everybody. And then the third number, the unfunded commitment ACL, has always been and still remains on the quote other liabilities section of Schedule RC. The detail of that is Schedule RCG, the other liabilities, and there's that allowance for credit losses on off-balance sheet credit exposures, which also is not a new call report code. That one has always been existing, but it will now be filled out from a CECL methodology. And I believe our next 3 slides just show that, right? The updated tool has your ACL for the loan portfolio. Again, that goes underneath the gross loans on the call report. The next one is that's the held to maturity securities value that you'll net out of your gross value to get the balance sheet value. And then finally, for unfunded commitments, right there's your total unfunded commitment calculation that'll go on Schedule RCG and then flow through to Schedule RC.
Great. Okay, so at this point, again, we'll take a couple of questions here. I also, before we get into the questions, we do have a few polling questions I want to just submit to everybody. So I'm gonna, as best I can, try to start these again. So the first question, to everybody is, did your allowance in the first quarter change? And so we'll take just a few minutes here to kind of get a sense of where everybody is. There are a couple of questions that are queued up. So once we finish these, I think there's 5 polling questions. We will jump and start taking those questions as well. Okay. All right. So about 37% saw an increase, 18 decreased, and 45% stayed the same. So let me just go ahead and share those results with everybody. And we'll move on to the next question here. Let's see. Here we go. The second question here, which is, did your Q factors change at all with the first quarter? So again, just an increase, decreased, or stayed the same. So we'll just give this another 30 or 45 seconds for everybody to answer. Okay, again, we'll end this one. We got a few more coming in there. Let me share the results here. So you can see 64% stay the same, 23% increase, and 13% decrease. So thank you again for answering that question. Next up are just charge-offs. Whoops. Oops, let me go back here. I didn't launch that right. Sharing, there we go. Do you anticipate an increase in your charge-offs this year? Just a yes or no response there. Okay. Just another few seconds. All right. 70%, 69% say no, 31% say yes. So again, thank you for your responses there. Let me move to the next question, just on reserve changes. So do you anticipate further increase in your reserve over the course of 2023?
And I don't know if Sean mentioned it, but we'll of course be sending everything out to you guys after the early next week. It'll have a copy of the presentation. It'll have a bunch of the a separate document which has a bunch of the answers from some of these questions, which we will have kind of given some more color on. And it'll also have the results from all these polls here that can be helpful in your planning to know what your peers are up to.
Agreed. And so 54% do see an increase to the reserve and 46% no. So we're down to just a couple of more questions here. All right, I think that one, the last one here is on percentage of your allowance. What percentage of loans is your allowance? Less than 1%, 1 to 1.25, and over 1.25. So this is the final one. We'll just give another 20 seconds or so for this one. And then, like I said, there's quite a few questions beginning to get teed up here. So we'll start to address those and
we'll jump right into the Q&A that we already have up there. And we have a lot of, we've been compiling questions, of course, as we talk to customers every day. And so we have a handful of questions in the slides that are to follow, but we'll make sure that we grab these questions that people are saying right now as well.
Okay, so thanks for your responses here. You can see about 24% are below 1%, 36% between 1 and 1.25, and 40% greater than 1.25. So again, thank you very much for your responses. As Steve said, we'll make this part of the information we send out, but let's just start tackling some of the questions that have been submitted. So the first one is regarding TDRs and just individual analysis. So I can't cite the guidance that I've seen. I mean, I have seen guidance from FASB on TDRs. And so the two things to keep in mind here are this. One, CECL does not require the formal analysis and the methodology that was used to be involved with TDRs in the ALLL. The whole concept of individually assessed and just specifically reserved loans, right? It's a little bit of a, if you think about it, right? In CECL, we're looking at these large pools. The guidance suggests if there's something very different from the pool, then you separate those, which would suggest, like we do in our tool, that you continue to separate those individually or specifically reserved loans from the broader pools. Probably the subtlety here is, like for the TDRs, you don't have to go through the in many cases, what was a very detailed process to account for those TDRs. But what we're seeing and what we believe is the right interpretation is that you'll still continue to essentially pull those from the broader pools specifically reserved for them and account for them that way. Now, that said, we certainly have banks who are not doing that. And again, I think it's going to be a little bit of with your auditors and regulators, but that's, the Fed in their scale tool carved out the specifically assessed. And so everything we've seen is you do want to separate those. And that's why we have that in our tool. Steve, anything you want to add there?
Nope. No, I mean, when we first saw, when CECL first came down the pike, everyone was assuming that we were just going to be, we were getting rid of the specific reserve, and it would all be in favor of pooling assets with similar risk characteristics. But then came up the obvious follow-up question: what about individual loans that have that share no similar? What about loans that share no risk characteristics with other loans? And so it came back in another form. So while they're removing the TDRs, you still need to evaluate whether there's a loan, individual loans that have enough issues where you don't see similar risk characteristics with the rest of the portfolio. And then we still need to deal with them on a one-off basis, just a different threshold for that. And I'm seeing some of the guidance here came from, we can find a couple links and send those along if you send us a note. I have the Federal Register thing here in front of me where it discusses the discontinuation of the TDR standard.
Great. Yeah, thanks, Steve. Maybe we'll cite that in some of the response material. We had just a question on where you can send questions. info@quickrate.com is a good way to go. Just using the chat feature. Or you can, email, any of the sales or service teams directly. And I apologize if you used an email that we didn't get a response to. So that was just a chat that came in. We had a large excess in the ALLL and are prevented by a consent order from reducing it. Again, happy to discuss that on an individual basis. Again, I think what we're seeing for most, or I shouldn't say for most, for some banks is certainly a surplus in the reserve. We've had a few instances where they've been asked to remove it, but for the most part, we typically see, even outside of a consent order, we don't see most of the regulators wanting excess reserves removed. We have had a few auditors who've done it. So unfortunately, the answer is I think, surpluses and unallocated are okay, but there's always going to be an exception to the rule, right? It's going to probably be 80-20 or 90-10. So Steve, anything you want to add there before we let that one move on?
No.
Okay. Okay. Any recommendation on what to present to the board of directors as an executive summary? So again, I think as Steve touched on in the export options, I think certainly the summary page or the new summary page are helpful. I think at a minimum, typically what I think, what I share or what we have our bank share with our board is in fact that executive summary. We do show the net charge-offs. I do show the peers because we're a bank that likes peer information. So we do show kind of the net charge-off activity of the peer information. I think it's important to continue to identify the individually assessed loans. And then certainly now with the new guidance, I do think you want to show them at least the HTMs and the unfunded commitments. So, and your Q factors, right? I think any discussion around those. So again, every board's a little bit unique in the amount of detail that they want to see. But I think that's, again, in the export options. That's why we give you the flexibility to really kind of hopefully cater it to your individual board and expectations. But again, happy to discuss that offline if interested. Steve, anything to add there?
No, and that's typically what we suggest. The new summary tab, which will be available for you guys next week. The loan portfolio summary, which just kind of gives your board a general concept of the steps that are required for CECL, right? You start by looking at your historical experience and what it would suggest, and then you see the modifications to that through Q factors, a summary version of the Q factors, and then what else needs to be considered, individually assessed loans. And so I think the loan portfolio summary tab On the historical tab, giving them all that granular detail for, gross charge-offs, gross recoveries, going back to the beginning of time, I think seems to be, overkill from a board perspective. So maybe just choosing the net charge-off ratio from the historical tab, and then some peer data and the Q factor. So along with what Sean said, and it's a very easy process to do that. Using our tool, there's an export button. When you click on that, you'll get a pop-up window, which shows all the different areas of the tool, and you can just check on those 4 specific areas we just mentioned and then export it to a PDF or Excel.
Steve, do you want to just quickly show them that? Just
yeah, and I can pull. I've got the development site back up. It's working again, so my heart can start beating again.
Yeah. So why don't you go ahead and show that, and we'll just keep on with the questions, but at least we can put that up there.
Yeah.
So the next question.
Let's see.
Yeah.
Go ahead.
I was just going to move on to the next question while you're doing that. The warm template and Q factor template provided are very helpful. It would be nice to have a prepaid template to help in completing the warm template. John, certainly happy to discuss with that offline. I think, right now we're really using assumptions from other people. Our goal here with prepayments, right, is this is an area, as we've talked before, where, precision at the expense of accuracy can be a bit, more time value than what you're getting worth of it, right? I think the important, again, directionally, any type of prepayment assumption is going to lower a warm. And so, whether it's 5% or 7%, to get to that level of granularity isn't going to impact the warm enough for me, in my opinion, to justify doing a whole lot of work, right? Ultimately, you can use our assumptions, which we're trying to gather as many as we can. But at the end of the day, if you want to get your prepayment assumptions, it's really going to be involved with using your data from the core and tracking, payoffs throughout the course of a year. Again, in my opinion, that's just more work than it's worth. We will continue to seek out industry resources on prepayment assumptions. But, again, whether it's your ALM provider or something like that, they may already be doing it. But again, I don't want to create work for somebody where it's not going to materially affect what's happening in these calculations. So, Steve, anything to add there before I?
No, I'm sorry. I just went back to the other functionality and I was showing them on the screen as you were answering that question. So I think everyone was able to see the export and how that worked. And I just previewed the new functionality here as well, where again, if you had a 6-year warm, but you wanted to use 9 years worth of look back period, you can choose a 9-year look back period and a 6-year warm. You just need to do a little bit of extra math, right, with that multiplier to get an accurate lifetime, 6-year lifetime loss rate.
Great. Okay. The next question is, how do I allocate a portion of the excess to the HTM component? Again, these are really 3 separate reserves, right? So in theory, I would say you would just create a new, establish a new reserve for those. Again, for most banks, these are going to be not very meaningful for the HTM or even the unfunded commitments. But essentially, if you're going to try to take it out of your, ALLL now ACL reserve, you're going to have to back it out. So that's why I think it's cleaner just to establish these new reserves than trying to reallocate, what's already in your existing reserve balance for loans. Steve, anything you want to add there?
No, that's exactly right.
The next question is there a report for Q factors for quarter-to-quarter comparison? Good morning, Michael. No, we don't currently have that. I mean, I think it's certainly something we can kind of take a look at and consider. But right now we don't show anything like that. Steve, any thoughts on that?
No, I mean, with some of these types of ways you like to look at data that don't kind of come by default in the tool, I hope, as a first step, the ability to export it all into an Excel environment. So if you had a scenario from last month or last quarter, and you wanted to show something showing the differential in all your specific qualitative factor adjustments from scenario last quarter to scenario this quarter, you just do an Excel export of last quarter scenario and do the same, export the Q factors tab on this quarter scenario. You can have 2 different tabs in your Excel spreadsheet, and then you can create a third tab where you just do a differential, and each quarter you could just update one of those tabs with your new scenario and kind of build your own little ancillary tool, which highlights the changes in your Q factors, either at a summary level or a specific level as we go.
Great, thanks, Steve. The next question again, is the Fred economic data in the Q factor tab the most current data or a quarter old? I would suspect, and it's a good question, Michael. I should know this. I think it's a quarter old, but I'm gonna double check that. Steve, on our graphs to the right in the Q factor section, I think it's a quarter.
Yeah, I have to check to see when we get it updated pretty quickly after we get the additional data from the Fred. So I'll have to check when they update different economic time series are going to be updated at different times. Some of them are monthly series, some of them are quarterly, and obviously the ones that are national are quicker, and the ones that are state-based tend to lag more. So it depends on the series, right? Because they're being aggregated from different areas of the BLS and other areas of from aggregated to Fred and then presented at Fred, and then it flows through to our tool.
Right, and so I think there's actually a couple of components to this, because I think, on the graphs on the Q factor tab, I would say those are a quarter old because those mirror and match up with the peer group data. In the industry credit research tab, that data is probably more is updated more frequently. So kind of a two-part answer there.
Yeah, that's correct. That's correct. There'll be what we want to make sure we're not doing is comparing apples to oranges from a time period standpoint. So if we have loss trends that go until last quarter because people haven't filed their call reports yet, and then right below it we show an economic data series, we want them to match up visually, from a left to right standpoint. And we don't want to shift the economic one a quarter so that we're, comparing apples to oranges. But again, if you want the most recent updated and more flexibility with the economic time series, the industry credit research tool will give you a lot more flexibility there.
Great. The next question is the provision for off-balance sheet exposure or unfunded commitments grouped in other expenses or the provision line on the income statement? That's a good question.
Other expenses or the provision line? No, I believe it's all part of the. I believe all of them are aggregated to the provision line on the income statement. Now, there's Schedule RI is our. I want to be clear, the summary income statement on your call report. There's still one line item for the loan loss provision. It's a great question because it's now a misnomer, right? It's still called loan loss provision, but we're adding in our provision for any changes we need in our unfunded commitments reserve, right? And any changes to the HTM securities ACL and the regular loan loss provision. All three of those are added. You're supposed to add together to get your quote, one single line item loan loss provision on your summary income statement. Now, the components of that, the three separate, duration income statement components of that are on other supporting schedules in the call report. Again, is it Schedule RIB changes in it is.
RCA? I'm actually looking at it because I was dealing with this question earlier in the week. So line 5 of RIB is your provision for credit losses. And then there's another line 6 for adjustments. And then in the memoranda section below that is where then they separate out the provisions for HTM and unfunded commitments. So my guess is, if you
let me show that for a second. I think it's a question we get a lot and something we're considering doing some additional work on the tool to make it clearer for you guys as you're dealing with the provision, adjustments as well. So let me pull that. I've got it up here.
Yeah, because like I said,
you need to give me
accounted for
access. Sorry.
Yeah, it's accounted for in the memoranda, and so I would say it's a separate one because in RIB it's showing it's I think it's kind of tracked in the adjustments.
All right, so I think I went too far. Hold on. Yeah, so first, just on Schedule RI, we have keep going up. There. Provision for loan and lease losses, which is footnote 3, which says those who have adopted, everybody, should report in item 4, the provisions for credit losses on all financial assets and off-balance sheet credit exposures. So all of them are aggregated in that one spot on there. However,
Good
you
catch.
still need them all separate.
Right.
Because of,
In the
Hold on, I'm gonna
memoranda
get
down
to it.
below RIB.
well, no,
Yeah.
I don't want, that's not, I'm looking for something
Oh.
else. RC. Hold on. Securities. No, all right, it's RI. Oh, yeah, it's RI. Never mind. It's RIB in the next section here. There we go. So, part 2 of RIB kind of shows changes in allowance for credit losses, which be, your beginning reserve balance, right? Your recoveries, your charge-offs. So this existed as a schedule, but now you'll notice there's provisions for credit losses. So this is all 3 of these. You add up this one and this one and this one. That gives you 2/3 of of what you need for the loan loss provision on your income statement. It's the provision for the loan portfolio, for the securities portfolio, and then separate right here, provisions for credit losses on other here it is, provisions for credit losses on off-balance sheet credit exposures. So here are the 3 duration income statement components that needed to be added together to get your quote loan loss provision on the income statement. It's not how I would have designed a new call report, but they didn't ask me.
Yeah. Okay. Thank you, Steve. That was
Sure.
good. And that's a little bit of the danger is we're getting much more familiar in terms of reporting on the call report. But sometimes we do go to look for additional help on that. The next question, good morning, Ben, is will ag loans ever be a separate line item rather than lumped into all of the loans?
All right. Let me, we've been asked this question. Obviously, it's very important for some banks and a lot of other banks, they could care less. The challenge with the ag loans, historically speaking, and a lot of these decisions or things we had to do with regards to how we chose our segmentation is about how call reports have changed over time. You guys deal with that and notice that it's a thorn in your side as much, if not more than in ours. And how not only balances, but really charge-offs and recoveries for ag loans as a separate segment have been treated differently. There have been threshold requirements where if it didn't meet certain thresholds, you didn't have to report it. And so we've never gotten perfect industry data over long-term in call report accounting for charge-offs and recoveries for ag loans, which is why we weren't comfortable showing them as a separate segment, because while we know balances, we haven't been able to follow losses on a perfectly additive way. All that being said, we're working on a workaround that will show the values just with some footnotes saying, hey, this industry data, your data and your peers' data might not be complete because of these limitations with the previous call report formats. So yes, we got it on one of the burners right now, and we're going to keep trying to add that with a caveat that it'll never be, perfect data.
Great. Steve, the next question, maybe you can pull up the tool again, because this is that adjustment column. So the next question is, how does the tool handle account for CD or cash secured loans? So again, in our summary page, there is a column, I believe it's E, for adjustments and exclusions. And so the best way to do that is to just, again, if you have those types of loans, pull them out of the pool where they're being captured on the call report, and then create a new row to reflect those balances for the cash secured. So again, in column E, let's say, for instance, let's just say you had $1 million of cash secured loans. You can pull them out of wherever. Yeah, pull them out of.
So right now I'm saying, let's say you've got other consumer loans, right? And you got $1 million, which are fully secured or guaranteed in any way. This exact same thing might work for a government guaranteed portion of a loan if you wanted to deal with it that way. You back out that, and what just happened is, instead of the entire $13.5 million applying a expected future loss rate to the entire 13.5 million, we're now applying that expected future loss rate to 12.5 million because we've excluded 1 million as now it can be excluded because it's fully guaranteed and you just want to simply remove it from the analysis, or if you just want to deal with it separately and independently. The individually assessed loans. Oh,
Well,
go ahead, sorry.
yeah, I was gonna say, Steve, and then you can go down to the plus button and add a row for that $1 million and identify that these are your CD secured loans, right? And then put the million in, and you don't need to necessarily have a reserve for it, but it'll still show you that you're accounting for that part of your portfolio. So it keeps everything even, but again, doesn't apply a reserve to something that you have 100% secure.
And this sounds crazy because it sounds crazy to me too, but we've seen situations for banks and for credit unions where examiners have demanded some sort of a small reserve even on fully secured loans because of some issue where the institution actually somehow took a loss on a fully secured loan of some sort in the past. And so that would be a situation we say, listen, I'm not going to apply the full loss rate to that balance, but they're demanding that I apply some sort of small loss rate, so I can come in here and add a 5 basis point expected loss rate on that $1 million worth, right? Just give them a grand there to add to it. So there's flexibility in excluding balances, in excluding them and treating them separately like this. Or if we're talking about individual loans, this is not where we do that, right? If we're excluding loans that are individually assessed, that gets done here, where you plug in the loan information, you say, hey, I've got a mortgage loan that's got a $250,000 balance and I expect to get 175 out of it because it's got some issues. When you do that, it's automatically excluded, right? It automatically excludes that $250,000 loan from the collected pool. So you don't have to separately deal with it. These adjustments and exclusions column are for other adjustments and exclusions, not for the individually assessed loans.
Yeah. Great. Thanks, Steve. Next up is, can we add additional Fred economic data into the menu? So, Michael, this is something we have been wanting to do now that I think this year we'll see more of those. So certainly submit anything you'd like us to see, capture and track. This is probably my fault. We had hoped to get some more of those added, but with all the other changes we've been making, we had not done that yet. But yes, we will add additional indicators. So if there's ones you're looking for, please let us know, and we'll get those added to the tool. Okay, next question is, how does CECL address a loan portfolio that was part of an acquired bank that has gone through purchase accounting? So this is probably one that we probably have to talk about online, right? There's certainly specific rules about portfolios that have been purchased for CECL. Obviously, it involves a credit mark, which I would imagine you would have already done as part of that acquisition. So again, I think this is probably one I don't want to go too far out on the limb here, because there's going to be unique circumstances to that transaction, but there are specific rules for how purchase loans are accounted for now in CECL. So happy to discuss and share with you what we have in terms of that. Steve, anything you want to add there?
Yeah, I mean, from a general conceptual standpoint, we get this question sometimes where people say, we acquired an institution a few years ago, so some of our older historical data on your tool is just our legacy institution, and then some of it now has on the books the acquired institutions loans as well. And how do we want to think about our historical experience as it pertains to our future expectations for losses? And our general rule is that they're looking to see what you expect in losses on the portfolio that you now run. So even if you inherited some of those loans, you've got the workout team, right? It's your underwriting standards and continual standards which will determine the amounts of losses that you expect to see on these going forward. So we typically say, your institution's historical loss rates are a much better determiner of, outside of some of these initial credit marks that you made, right, for the future expectations of the combined portfolio. So I don't think getting into too much complicated, trying to do recreate the old pooling of interest accounting method in order to take into account some of these older ones from the acquired institution is usually not much juice for the squeeze. Sean?
Yeah. Great. Thanks, Steve. There was a follow-up question on our example of the fully secured. Should the loss rate be adjusted? I mean, you could. I mean, to me, again, this gets into, the charge-off is on that entire pool. So, theoretically, should you adjust it? Sure. Is it going to materially impact the difference? I would say no. And so, again, it's a precision accuracy thing. You could certainly make that argument. I just would tell you, for the impact that it's going to have, I'm not sure it's completely worth it. Okay, next question is, I was curious how many respondents there were for the allowance polling question. Can you provide the exact number or the approximate number? Yeah, Nick, I mean, we had 209 people on the present or the Zoom when those questions were asked. I waited till it got to be about 75% for all of them. So some will be slightly more than 75%. So probably approximately 150 respondents to most of the questions this morning on all of the polling questions. Okay, next up, good morning, Tony. Can you give us some preliminary examiner comments? I know some of that's been going back and forth in the chat. I think our examiner comments, have been as expected. I think they have ranged from one of, just curiosity. We just recently finished our OCC exam at our bank here in Illinois. They asked a lot of questions, didn't have any real feedback. I think they are indicative of what we're seeing from a lot of them is where the examiners are really just trying to understand what banks are doing, the different methodologies and how they're handling it. They were happy with what we were doing with CECLSolver. But again, I think as much as anything, they want to see that you have adopted, you're in place, understand what you're doing. I suspect in future exam cycles, they may start to dive in a little bit deeper, but everything we've had so far, we has been favorable. Steve, I don't know if there's anything else you want to add there.
No, we haven't. We occasionally get questions for some more detail about, how some of the calculations are done that they couldn't find details on in the, in our SOC report, and we try to add additional resources in the CECLSolver resources button on the tool, which kind of provide a little bit more detail on how we do some of those historical loss calculations. And then we also, as part of our exporting options, there's an option to kind of export all the kind of a data dump of all the quarterly values for your institution. Those are tools you can use whether you're internally trying to validate bits and pieces of a tool, or if you're in an exam and they're asking for some additional detail. But we have not gotten any real significant negative feedback on the way the tool works, right? The methodology behind the tool or its appropriateness for the for any of our users. I think feedback that we get is more along the lines of, just like it always has been. Is your reserve higher than they expect or lower than they expect, and your justification for those changes over time. So we're seeing the same kind of feedback from examiners on reserves as we always have. It's not as much methodology driven. It's really just, is it higher or lower than they expected? And then do you have good explanations as to why? So kind of the same game we've always been playing.
Yeah. The next question is, why is the calculated ACL to total loans before adjustments only calculated on the gross loans? I've had some custom pools created and the percentage excludes those. So it misrepresents our loan loss percentage on the summary. That's a good question. I mean, I don't have it off the top of my head. I guess I'd have to take a look, but certainly if you email us afterwards, I don't know who asked the question. We can take a look at it. Steve, I don't know if you just have.
Do you mean the gross loans versus net loans?
I think so. That's why I said it's probably. Yeah,
it's something we'd have to look into. But the trick is, on the call report data, we don't get reserves on. We don't get net values on different segments of the portfolio, right? Obviously, we have all the individual loan portfolio gross values, and then we have a total reserve, and then we have the net loans. We don't have net loans on a segment to segment level from the call report data right now. So, and our tool is designed, the summary page is designed to pull the data from the detailed segment page. So since we're not making adjustments, since we can't get call report data on reserves, on net values at the segment level, it doesn't aggregate into the to the summary tool, but we can certainly look for a different way to visualize that if that makes sense for us to do it. So that's feedback that we want to see, specifically how you'd like to see that on the summary tab, and we'll take it into consideration.
Yeah, and I think that probably just goes, as more of an overarching request, to everybody, right? So again, our focus was to get everybody here, adopted, implemented, et cetera. We really feel like this year we will have more of an opportunity to fine tune or make specific adjustments or improvements based on feedback. So, if you have things you'd like us to consider, please email those with as much detail as you can, and we'll review it. I mean, we are constantly evaluating areas where we want to make the tool better. So, again, specific scenarios, specific requests, emailed to us are certainly welcome. The next question is, we did not see a material change in our reserve due to CECL. Is it okay to put 0 in RIE 4A effective adoption methodology on the call report? I asked because it does not seem like 0 as an answer. It doesn't seem, I'm assuming that doesn't like 0 as an answer. Yeah, I think that's probably, I would agree, but it could be something on your software. But Steve, this is the call reports. I think this is where, obviously you're gonna, impact it in a couple of different places that,
the effect of adoption on current expected credit loss methodology on the call report, that's,
RIA, and then
well, I'm not looking at the call report. I was just talking, conceptually. Conceptually, that's there so that they can calculate if there's a, if there's a differential, right? If you had a one-time increase for your adjustment, then we're going to want to be calculating. We'll have to use what that adjustment is to help with our phasing in of the risk-based capital recalculations, right?
Yeah.
And so that's why that's there. But I'd have to look and see why 0 would be an inappropriate response there. Not looking at it, it sounds like if you had no adjustment, then 0 would be absolutely the appropriate response. But I'm not looking at that line item.
Right, and that's why I feel like it's almost maybe an issue with their software for the call report, not necessarily.
I'd be shocked, Sean, if there was an issue with.
Yeah. So anyway, so that's it. All right. The next question is the reserve for unfunded commitments considered tier 2 capital, even though it is a liability? That one I'm going to probably have to look at, because again, those changes are going to be captured in your capital numbers, your bank capital numbers. But I'm going to have, I honestly, I don't know. I don't know that for 100% certainty. I don't know if I want to answer that one, Steve.
Yeah, that's a really good question as to where those show back up in the capital structure in Schedule RCR. We'll get back to you on that. I'll take a closer look.
Yeah, like I said, I don't want to give that one because I'm not 100% certain. Okay, so thank you for all the questions. I know we're getting close here. Let me just see. Tony, thanks for the comment in the chat. You can see his examiners took an afternoon to train on. So that's good feedback in the chat from Tony to everybody on not only examiner feedback, but also CECL. So, as we mentioned, Stephen, I'm going to take back the screen here.
Yeah, go ahead.
We didn't really get to all these, but you can see as I flip through these, we had a number of questions that, again, we've been accumulating from all of you. So we're going to do our best to include these and answers to those in a follow-up document for everybody early next week that we'll work on. And as well as, touch on the questions we received today. So Just a reminder, we'll be back here just again in a couple of short weeks to do another Q&A. So, again, I'd say, continue to bring your questions, continue to bring your feedbacks, any concerns, questions. We'll continue to try to best we can answer those. We will have, some guests coming on. I know we won't have it for the May one, but we will for the June presentation. So again, we appreciate everybody tuning in and coming in and supporting these coffee talks. We hopefully you continue to find them beneficial. We do have a webinar on May 16th just on the Q1 results from the call report as well. As I mentioned, we do have a number. We'll continue to enhance and make improvements, what we think are improvements to the tool. So we'll do our best to not only notify you those during the coffee talks, but also with an email before those changes go out. Steve, any final comments or information to share with our banks here before we let them get back to their day today?
No, again, I would just encourage everybody to give us feedback whenever you see things that you'd like to see on the tool, or different ways of visualizing some of this data that's helpful, whether it's the exam or the audit process, or just in summarizing it and sharing it with your boards, because we're continually looking for better, cleaner, more straightforward ways to present it, and while allowing additional customization, when and where it can really be helpful.
Great. There's a question came in. Our previous sessions available? They are. I don't know that we have them all out there, but on our YouTube channel we have many of these. But Angie, you can email Jennifer, Kelly, or your sales rep, Pam, Ricky, or Melissa, and they can get you information on the previous sessions that you can log into the YouTube channel and see those as well. Okay. And again, any questions, email us at info@quickrate.com. Certainly email, Ricky, Pam, or Melissa with any questions. There's always the chat feature available to you when you're in CECLSolver. But on behalf of Steve and everybody here at QwickRate and QwickAnalytics, again, thank you all very much for continuing to support these coffee talks. We're trying as best we can to answer everything as where we can. I will admit we have stepped out a little bit further, some instances around the call reports where we certainly become more familiar with them, but we're trying to make sure when we do give responses, we've checked with other resources as well. But we'll continue to answer his questions as best we can, and we'll look forward to speaking to you again next month, and appreciate your patience and support with us. And we'll continue to work through CECL and any of these issues. So have a great weekend, and we'll look forward to speaking with you again soon. Thanks so much.
Thanks, everybody.